Hello, everybody. This is Steve Wolf with another edition of Steve's Stock Stories, and I'm here with my cohort and producer, Jocelyn Magana.
How's it going, everybody?
We are doing great. Hey, today we want to talk a little bit about value stocks and growth stocks. Why do we want to do that? Well, over the last year or so, with all the COVID stuff that was happening, certain stocks did really well and other stocks didn't. It was really a bifurcated market. And what really did well were growth stocks. So we kind of wanted to tell people or explain a little bit about what the difference is, because actually right now the value stocks have caught up a little bit to the growth stock. So what is a value stock? Basically, a value stock is where you believe that the value of the company is greater than the stock price today. Now, I could tell you that growth stocks can be value stocks in that their value may be less than what you think they're really worth. But generally speaking, growth stocks have a higher price to earnings. They have a higher, all the metrics are a little bit different on growth stocks. So with value stocks, these companies, they're trading below what they think they're really worth. And you can use a lot of different metrics to say, is this worth what someone thinks it's worth, like, price to earnings or free cash flow or price to book. And these are all things we talk about. And actually, we've talked about these before in Steve's Stock Stories, so you might be able to get a hold of one of our previous webcasts here, podcasts, I should say. But growth stocks are companies that have the potential to really outperform the overall market over time. And they basically have maybe a little bit higher risk than a value stock. Just to give you examples of these stocks, and we're not saying that these are stocks we recommend necessarily buying, but a growth stock has something like Apple Computer over the last many years. Many of the technology stocks are considered growth stocks. Their idea is we're going to grow the share price. We're not so much worried about, dividends, which usually value stocks do a little bit more. Value stocks are a little bit more worried about, let's pay the shareholder through dividends, which come through the earnings, of course. With growth stocks, a lot of the earnings that come in go back into the company because they are reinvesting or investing in new technology or in new land or new whatever so that they can grow. So now, which one is better? Really, there is no one that's better or worse. It kind of depends on where you are in life, and how much risk you're willing to take. Because generally speaking, growth stocks carry a higher risk than a value stock. You can imagine a stock like Procter & Gamble. Again, this isn't a recommendation or anything, but a stock like Procter & Gamble is a value company, and they're not expected to grow by more than 2, 3, 4, 5% a year. Whereas, you get a stock like Google or something like that, and you may expect them to grow by 10 or 15% a year, or maybe some of these micro cap stocks, they may grow at 20 and 50 and 100% a year. Okay, it's just, you go up the risk scale when you basically go up to growth stocks. In the long run, which does better? Really, it's kind of a toss-up. The value stocks actually, probably because of the dividends that they pay, especially if you reinvest dividends, actually have outperformed the growth stocks by a little bit, but it also depends on what time frame. So the last maybe 10 years since, actually it's been a little bit longer than that, really since the 07, 08, 09 disaster with real estate, growth stocks have really outperformed, and especially in the last few years, especially last year when you had the COVID problem where nobody was going out of their house and everybody was using online this and online that, getting things delivered. I mean, the growth stocks, the technology stocks just went up like crazy. So, give you a good example. And by the way, there's nothing black and white about this. Some stocks that people consider are growth stocks. You also could say, well, they're value stocks, or a value stock could be kind of growthy. So, the way Morningstar gets around it is they have 3 different classifications, and Morningstar classifies these things. You're either growth, value, or blended.
And that blended comes to mind when you mention Apple, for me at least, only because Apple seems like it's been around for a long time. Now they've pivoted they've done some pretty good pivoting, based on their technology, and probably even some of the things that they're getting into now. But they seem almost like a blended company. I don't know. Correct me if I'm wrong in my assessment. Oh, and before we get to that, just remember this is for educational purposes only. We're not giving out financial advice. Anything that we talk about here, stocks that we're talking about, we're not suggesting you buy any of these or sell any of these. You really need to talk to a licensed professional to get professional advice for any type of investments that you make.
That's correct. So this is just informational purposes. So your question was about Apple. I would say Apple is still a growth stock. For whatever reason, they have not gotten the high price to earnings value that a lot of other growth stocks have gotten, yet they are, I think, the biggest company now in the world. They were, I think, the first one that hit the $1 trillion mark not too long ago. And I'm not really sure why they don't get a higher PE, although I will tell you that at one time their price to earnings ratio, that's price divided by earnings, was somewhere around 8 or 9 for a long time, 10, something like that. And now I believe it's closer to about 20.
I was going to say, that's really low for a technology growth stock.
Absolutely. So that's why you could say, well, some growth stocks could be looked at maybe as a value play. And the truth of it is, everyone thinks their stock is a value play, because if you buy a stock, you're certainly thinking that you're buying it at a lesser price than it's going to be at some time in the future, right? But some stocks are fairly valued based on the analysis, the metrics, where, say you think a stock is worth $15 and it's at $15 and it's going to grow by 5-6% a year. So next year you think it's going to be worth whatever that is, 16, 17. All right. But then there's some stocks like Apple, which I think for a long time was undervalued. Now it's kind of getting its due. But I think one of the greatest examples of a value stock, it's the epitome of it, was something that happened to Johnson & Johnson back in 1982. Some of you may remember this, obviously, if you're old enough. There was a time when some sicko decided that he's going to go into the grocery stores or wherever they were, and get a hold of some extra strength Tylenol capsules. And what he did was he went in, he took capsules out and replaced what was in there with cyanide. Well, obviously cyanide's poison. So someone was taking the pill and died. Then another person died. Then a third and fourth person died. Well, now, people are scared of what's going on, and Johnson & Johnson had no idea what was going on. So they actually they recalled everything off the shelves. There was about $100 million worth of Tylenol extra strength capsules.
I mean, they pretty much did the right thing, at the time, because I think they probably took a huge hit doing that.
Oh, huge. As a matter of fact, nobody recalled anything in the old days. In those days, they kind of hemmed and hawed and didn't do anything. But to their credit, they said, we don't know what's going on here. Let's just take everything off the shelves no matter where it was, even though this is only happening in the Chicago area. Well, at that point in time, they actually had about a 37% market share of the pain pills. Okay, and this was a capsule. Their share went down to 7% very quickly.
What do you mean? It went down by 7%?
No, it went down to 7% of the market. They had 37%.
Okay, I got you. Okay.
And it went down to 7% of the market. And meanwhile, the stock plummeted about 30% in a very short order because, people said, oh, my God, they're never going to recover from this. Okay, I mean, a lot of people didn't think they'd survive, really because there was no precedent for what happened. And here they were taking everything off the shelves. And not only was this a personal tragedy for obviously people dying, but the financial and public relations nightmare for the company was just unbelievable. They estimated that they lost something like $1.24 billion just due to the depreciation of their brand name.
That seems like a big number.
Well, it is a big number, especially back in 1982.
Yeah.
I mean, you're looking at 40 years ago. So the company finally found out what happened, and they found out that the capsules, were laced with cyanide. And apparently there were enough capsules that were laced that would have killed thousands of people had they not taken it off the shelves.
I remember the story, but I didn't remember that part.
Right. So eventually, of course, this led to J&J becoming the first company to put tamper-proof packaging.
That. Yeah. I mean, now I'm afraid to eat anything that doesn't have that tamper-proof packaging.
Exactly. And after a long and expensive marketing campaign, and the company regained a lot of its market share. I think it got back up to about 30%. And the point of this whole story, other than to say that there's some very scary and demented people out there in the world, is that this really became the epitome of a value stock. The stock went down by about 30%. Meanwhile, the analysts started doing their analysis. Well, what happens if extra strength Tylenol never made it? If they didn't make it back, what would happen to the company? Well, someone figured out that it was about 17%, that the sale of that drug was about 17% of their revenue. But the stock was down by about 30%. So those people who felt that the company was going to make it, what they did was they said, we're going to buy this company. And sure enough, of course, when everything finally came back, they made a lot of money and, of course, continue to make a lot of money on Johnson & Johnson. It's been a great company for a long period of time. So, and the epilogue of this thing is that they never did find who the person was who did the poisoning.
That's really scary.
It's really scary, but there was a person during that same time frame who tried to extort money from Johnson & Johnson. I think he was trying to get $1 million or some dollars from Johnson & Johnson, and that person was actually put in jail, but there was never any proof that he was the poisoner.
Wow.
So they never really found out who that was. So, but interesting. I mean, a lot of things changed with that, not only with tamper-proof packaging, but the idea of recalling everything, that was pretty new. Other than maybe some cars that, the brakes didn't work.
Right.
That during the time that a lot of the American cars were just terrible at that time. But so that's a good example of a value stock.
So what I'm gathering here from a value perspective is it basically a good company that may have some bump in the road that may not be catastrophic. It may appear to be. And when they recover from that and they get back to the status quo as far as they kind of get through this mess, that it's still a good company and the value is down temporarily and it's a good deal. Is that what you're saying?
Well, that's part of it. And sometimes it doesn't have anything to do with a bump in the road.
Okay.
I mean, just sometimes companies are not valued at what people think they're really worth.
I see what you're saying.
There could be some companies out there right now that, for whatever reason, COVID, who knows, that people don't think are worth whatever the stock price is right now. And so what'll happen is either they'll be proven right or wrong.
Right.
Either that really is a good price for them or it's not a good price. And it's interesting too because there's a theory, the efficient market theory, that says at any given time all the information known is in stocks.
Right.
I'm not convinced that that's true because a lot of time, first of all, if that were the case, then there would never be an undervalued company. It would always be valued properly. But there are value managers and there are growth managers. So so that theory, I think, I'm not sure it really stands a test, and I'm sure there are a lot of people who would argue with that.
Well, it could be too how you interpret the information that's available to everybody.
Well, I understand, but again, it's one of those things that says if all the information is known, then that stock price should be perfectly known.
But I guess that's what I'm saying is that, like you said, in theory, that's the way it's supposed to work. However, when you look at, I can't remember the name of the guy. Who's the Big Short guy, right?
Yeah.
Everybody had all the information, but
Right.
he was the only one making the bet.
But they didn't have the information. That was the point, is that he actually went out and looked at the houses that weren't being built or weren't being, where there were mortgages for nothing. Okay, so all the information wasn't there, and that's the point. That's why he made him. And I don't remember his name.
I can't remember his name.
Right, but that was on The Big Short, and he knew what was going on, and other people either ignored it or didn't know it.
Yeah, but he had some hints along the way. I mean, something tipped him off, right? That this was going on, that he should go look at these houses, right? Something was trending in a way that he said, something's not right. I need to actually go in the field and investigate this.
Well, that may be true, but the point is that all the information wasn't known by everybody, and that's the bottom line, and it never is. I mean, insider trading happens, but that the government has kind of really clamped down on that type of thing. So it's just a matter of sometimes people just don't think a company is worth it, and sometimes it is. No, other times it's the opposite. Companies are at a certain price, and who knows what happens. something bad, or who knows, and all of a sudden it's worth less.
Or it's overvalued, right? Like GameStop and the whole Reddit fiasco type of thing, right?
Well, yeah, we're not going to get into GameStop. We did a whole thing on that.
Yeah. So I digress.
Yeah. So anyway, there's some differences between value and growth. And basically, growth is just saying, hey, we're going to grow at a much greater rate than a value company would grow. We're not really going to pay a lot of dividends. Most growth companies don't, certainly in the beginning. In time, they do. And eventually, the good growth company becomes a value company, because you can't grow a battleship, twice as fast as a rowboat. Okay, you can turn that rowboat a lot faster than you can a battleship. And that's the same thing. Small companies grow faster than large. I mean, a great example of that is Sears. Back in the last century, in the 1900s, Sears was the company. It was the biggest retail company in the world, and it was growing like crazy. Today, Sears went into bankruptcy. I think there may be a few stores left.
That's a really sad story. I always think of them as the first internet company, because they had the catalog, right? They would go to everybody, I don't know, Pony Express or the train or however that worked back in those days, right? And people would buy off of the catalog, which now basically we buy off of a screen, which is a digital catalog. And it's really sad that they started there, they went brick and mortar, and they didn't make that pivot, right? And got smashed.
They did. And it's funny and that's what happens. That's what happens with stocks. That's why there's a time to buy and a time to sell. That's why you have to know when a value stock is no longer appropriate, or where a growth stock is no longer a good thing to own. That's a whole different discussion. But Sears is a great example of one that went from growth to value to out of business. And believe me, most companies eventually go out of business. It's hard. I look at a GE, for instance, which has been around forever. It seems like, 1850, 60, something like that it started. And here it's still there. But the company keeps morphing.
Yep.
And that's what you need to do. You need to stay with the times. Anyway, that's our discussion on value versus growth stocks. Jocelyn, thank you for joining me. And everyone out there, we'll see you next time.
Always a great time. Catch you next time.